Hello class. In this particular chapter, we're going to have a conversation about public choice, taxes, and the distribution of income. The public choice model is basically a model that tries to apply economic analysis to government decision making. And there are a few things that come out of the public choice model. I always like to save my students a little bit of time, and I basically help them understand that the way we analyze companies is just kind of like not the way you analyze the government, because it's just not possible to apply the same kind of single-minded profit maximizing behavior to the government. So the public choice model eventually ends up concluding that it's not possible to use the same kind of thinking that we apply to companies to the analysis of the government. But there are things that we learn from understanding or trying to understand the behavior of the government. The first thing that we like to talk about when we get to this level is what we call the voting paradox. The voting paradox is the failure of the majority of votes to always result in consistent choices, and therefore in a democracy to have people that are happy with the outcomes of an election, for example. So to understand this, let's kind of look at this example here. So imagine that Professor Choi is your representative in your area, and the people that I represent are Lena, David, and Caitlin. And imagine that I have, say, $1 million that I need to distribute among these three policy things. All right. Now imagine that I send Lena, David, and Caitlin a survey, and I ask them, hey, ranking 1, 2, 3, which of these do you think is most important to you? Now, Lena ranks it like this. Cancer research is the most important, mass transit is the second, border security is the third. David decides to rank it like this. Most important is border security, second is cancer research, third is mass transit. And Caitlin decides that mass transit is the one that she cares the most, then border security, and then cancer research. All right, notice that everything has a 1, a 2, and a 3. So cancer research is a 1, a 2, and a 3, mass transit has a 1, a 2, and a 3, and border security has a 1, a 2, and a 3. Now imagine that Professor Choi does whatever my constituents told me to do. In other words, I take my money and I split it equally in 3, and I give a third of the money to cancer research, a third of the money to mass transit, and a third of the money to border security. You would think that I will be reelected in the next election, correct? And you'll be wrong, because what we normally tend to see is that when politicians do what the average of their constituents tell them to do, they normally don't get reelected. So how does it work? Well, in a very basic way, notice the way Lena is going to think. If Lena notices that I only put a third of my money on cancer research, she's basically going to remember that I did not put enough money on cancer research, and that I put too much emphasis on border security. David, on the other hand, is going to remember that I did not put enough money on border security, and I put too much money on mass transit. And then Caitlin is going to remember that I did not put enough emphasis on mass transit, and I put too much emphasis on cancer research, which she didn't care for. So basically what I just did is I made everybody unhappy. Instead, what most politicians normally tend to do is they tend to satisfy the constituency that they normally think is going to likely vote for them again. So what politicians normally tend to do is they tend to make happy whoever they think is their core, and then whoever they think they need to make happy so that those people, independents, can vote for them the next election. And they tend to sort of avoid making happy the individuals that are not going to be happy with their decision regardless. All right, so Kenneth Arrow developed something called the Arrow Theorem. And the Arrow Theorem basically says that no system of voting can be devised that will consistently represent the underlying preferences of voters. And what that basically means is that it doesn't matter how we design a system of voting, you will never be able to represent what voters really want, because voting by definition has choices and therefore winners and losers. So losers are always going to be unhappy that they lost, winners are going to be happy that they won, and then it goes on and on and on, depending on what side of the coin you are every time there is voting. So in general, what we have learned is what we call the median voter theorem. And the median voter theorem basically says that the outcome of the majority vote is only likely to represent the preference of the voter who is in the political middle. If you're a voter on either the extreme right or the extreme left, very few things are going to satisfy you, because most politicians tend to move to the middle once they are elected. In a very basic way, and again, just imagine we can divide people into right and left, which, by the way, is not correct, but let's say we could, okay? And we put some people on the right, and then we put some people on the left. Now, in order to get elected, a particular politician needs to have 51% of the votes. So they got to have a core of people. I don't know, let's call it about 33% or so. They're core people. And then in order to get elected, they have to convince most people on this portion here. Now, most people on the extreme right and most people on the extreme left are not going to like each other either way. So in order to get elected, a politician needs to have 33%, plus he needs to convince enough people in the political middle that he is better than the other candidate. And then you can get to 51%. The politician on the left is basically the same. People on the left are always going to vote for him. Let's call that 33%. By the way, I don't know if 33% is the actual number, but the whole idea is that there is a core of people that will vote for you regardless, and they don't vote for the other team because they just don't like them. Same thing on the right. There is a group of people that will not move regardless of what you tell them or what happens with the rulers that they have. They will be convinced that the ruler is correct regardless. Okay? So everybody on the right team and everybody on the left team is basically using blind sides every time they vote. The people in the middle are the only ones who are really moving, swaying in elections, right or left. And they're usually the ones that need to be convinced when an election comes in. The other people usually pretend that they need convincing, but they regularly vote in a particular way. Alright, so outcomes of any voting, if the right wins, it's not going to make anybody on the left happy, and if the left wins, it's not going to make anybody on the right happy. The only people who are going to be semi-happy are the people in the middle. So the theorem basically explains that the government is bound to fail in its quest to make everyone happy. The only people who are going to be quote-unquote happy with the government are the people in the middle, who flip-flop all the time and understand that sometimes you lean to the right and sometimes you lean to the left. Unfortunately, does that mean that the government has failed? Well, not quite. I need you to understand that even though the democratic process is very painful and sometimes the right wins and sometimes the left wins, it is a better process than in other countries where it's always right or it's always left or it's always whoever is in power. So at least in this country, you have some people on one side and some people on the other at any particular point in time, and everybody's opinion is usually at least listened to. Unfortunately, what it does mean is that a lot of politicians, once they get elected, they really are looking after themselves. And this is what we call rent-seeking. Not only politicians, but individuals in our system, they understand that everybody is pulling for themselves. So what ends up happening is whoever understands, like major corporations, etc., they would pay lobbyists in order to visit representatives to convince those representatives that they are necessary and extremely important in society. The banking lobby is extremely powerful in the US. Just to give you an idea how many lobbyists there are for the banking industry in the US, If you go to Washington today, there are 5 representatives for every one. There are 5 lobbyists from representing the banking industry in Washington for every 1 representative that there is out there. Let me repeat that. There are 5 lobbyists from the banking industry today working in Washington, D.C. for every 1 representative that we have out there. Inside of Congress, you end up with a lot of what we call log rolling. Log rolling is when 1 representative in Congress approves a particular bill in exchange for favorable votes from other members later. What it basically means is that in Congress, in order to get something done, you need to start forming coalitions. And a lot of the times, what these coalitions basically do is a sort of quid pro quo. I vote for you today, you vote for me tomorrow. And you end up with a very partisan environment inside of Congress because, of course, people that are lean in the same political thinking will normally end up working with very similar people. Now, voters understand that this is how things are happening. In other words, it's not like voters don't know what's going on and people don't know what's going on. It's just that everybody's sort of participating in the system. Plus, most voters are so busy with all the things that they have to do every day that they lack the incentive to actually get educated and learn about the real choices. So the majority of the voters today, they don't really pick what they think is the best representative. They just pick a lot of the times, based on politics or things of that sort. It is kind of sad, by the way, that this is kind of like where democracy ends up at, but it is where we are today. All right. Now, is it possible to just get rid of the government altogether? Not really. Most economists agree that the government can be very inefficient and Congress can be very, what's the word I'm looking for? Difficult to understand the process. But it is still a better process than not having a government and on top of that, other sort of dictatorial societies. We can reduce the problem of rent-seeking by creating regulatory agencies inside Congress that would uphold basic standards. All right. One of the things that I like to do when we talk about taxes, the first most important thing that I like to do when we talk about taxes is to talk about all the different taxes that we collect in the US and where do they go, because we do pay a lot of taxes. Individual income taxes are paid in the US. They normally tax wages, salaries, and profits. We pay also corporate taxes, we pay social insurance taxes, we pay sales taxes, we pay property taxes, and we pay what we call excise taxes. An excise tax is a tax on anything really that we consider a sort of luxury or something of that sort, or anything the government can tax on top of something else. So let's talk about where taxes normally go. So I like to kind of separate it into the governments, and we have basically at the top the federal government. Now the federal government normally collects income taxes, and that is the largest portion of the income that goes into the federal government. You need to remember that, by the way, it's usually a test question. The federal government also collects what we call payroll taxes. And payroll taxes are stuff like Social Security, Medicare, and unemployment insurance. All right. And again, they usually through payroll, they also collect the prepayment on income taxes. The federal government also has excise taxes. And excise tax, for example, we have taxes on gasoline at the federal level, oil production. We have taxes on alcohol. And we also have tariffs on imports. Again, these are just some examples. All right. Now, another government level is the state level. Now, at the state level, the majority of the money comes from sales taxes. And that's the largest portion of the income that states government normally collect. You need to remember, again, we need to remember that for the purpose of the test. Normally that's a test question. Now, most states also collect income taxes for the state. So if you live in one of those states where they collect income taxes, you would have to pay income taxes for the federal government, and also you would have to pay income taxes for the state government. The state government also makes money on excise taxes. For example, toll roads, fees for, let's say, paying for your driver's license, things of that sort. Also, for example, traffic tickets. All right, at your local level, we have our county and we have our city. Now, most of the money that the city and the county collect comes from property taxes. And that's the largest portion of money that comes into the county and the city government is property taxes. And again, you need to remember that for the purpose of exams, usually a test question. Now, the county and the city government can also collect sales taxes. One of the sales taxes that they collect, for example, is this occupancy tax in hotels. That's an example. Plus, they also collect a sales taxes on top of the state government taxes. So usually you have to pay sales taxes to the state government, and if the state tax, for example, is 6%, but in your county you're paying 7%, then it means that you're paying 1% to the city. Now your city also collects permits, fees. So building fees, building permits, construction permits, parking fees, for example. And those are excise taxes. Stuff like parking fees are also collected by your county or city government. All right, and these are the three major sort of governments. Now, if you live inside a homeowners association, for example, or a condominium association, then you also pay an association fee. And your association, your homeowner or your condominium association, it's basically like your village. It is your smallest type of government. All right, hopefully this clarifies a little bit who collects what taxes. All right, this gives you, this right here gives you a bit of a breakdown on who collects different taxes. So if you look at the federal government, the individual income taxes is 42% of the amount of money that they collect. Social insurance is about 36%. Corporate tax about 15%, and excise tax about 7%. If you look at your state and your local government, you're going to notice that sales tax is the large portion of the money that they make. Then you get property taxes. Now remember, the sales taxes mostly go to the state, and then property taxes mostly goes to the local government, that's the city and the county. Then they make money on grants from the federal government, and then some of the states collect income taxes. If you're interested in figuring out which states collect income taxes and which states don't collect income taxes, you can just go online and Google the states that collect and don't collect income taxes. Actually, let's real quickly take a look at states in the US that do not collect income taxes. And usually that's a shorter list. All right, so again, this is the quick list on income taxes, but at the state level. So again, remember you pay federal income taxes, and then you would have to pay state income taxes if you live in the states that pay income taxes. So this right here is the basic list. the states that are in red do not pay income taxes to the state, and then the ones that are dark pay more income taxes. The ones that are light blue pay a smaller percentage of income taxes. All right, income taxes in the US are progressive. And what that basically means is that the higher the income level that you make, the higher the tax on the amount of money that you're going to have to pay. Income taxes are not regressive. Income taxes are progressive. Now, we have other taxes that you could argue are regressive. For example, sales taxes can be regressive because poorer individuals pay a higher percentage of their income in sales taxes compared to richer individuals that pay a lower percentage of their total income on sales taxes. So you could argue that sales taxes, even though they're flat, they're income regressive. But income taxes are progressive, which basically means that the more money you make, the higher the tax that you're going to have to pay on your income. Now, I like to kind of help you understand a little bit how you pay income taxes. Usually I don't test you on it because it's a little difficult to figure it out, but to understand the amount of money you pay on income taxes and how you pay it, we need to understand the difference between the marginal rate, the average rate, what we call a deduction and a credit. So the marginal rate is a fraction of each additional dollar that you're going to pay in taxes. The marginal rate increases the more income you make, but every person pays the same amount of taxes on the same amount of income. So the marginal rate increases as you increase your amount of income. All right, so let's take a look at an example of income taxes. All right, so this right here is the income tax bracket for the year 2008. The year, by the way, doesn't matter. Income tax bracket look very similar to this. So let me show you the current income tax bracket. Now, every year the IRS has to basically give us the income tax bracket. So this is kind of like what the income tax bracket look like. It tells you the marginal income tax rate depending on the level of income. And notice that income tax rates, the marginal rate increases the higher the income level. And then it's separated into three basic brackets. You have single, you have married, and you have head of household. All right, so this is an example of a bracket. Imagine that any money between 0 and 8,025, you got to pay 10%, 8,026 to 32,550, you got to pay 15%, and so on. Now imagine that you have somebody who has $100,000 that they need to pay, that's their taxable income, okay? So if you got $100,000 in taxable income, then the way you figure out how much money you got to pay is by following the bracket. So any money between 0 and 8,025, you got to pay 10%, which if you look at down here, that's what that number is. So 80250 is 10% of 0 to 8,025. Now, because this person makes $100,000, we got to keep moving up. So on the next bracket, any money between 8,026 and 32,550, you got to pay 15%, which is the same thing as 3,678.75. Now, if you make any money between 32,551 and 78,850, you got to pay 25% on that bracket. So that adds up to 11,575. And then any money between 78 and 164,000, but notice that this person makes 100,000. So any money between 78,851 and 100,000, which is the same thing as 21,150, you got to pay 28%, and this is 28% of this money. You add up all of this stuff, and that is the total tax payment. All right. Now, to understand how you end up with the taxes, let's start at the top. So at the top, you have your gross income. Now, after you gross income, you got to subtract your deductions. Now, most people today in the US take what is called the standard deduction. If you don't take the standard deduction, then you basically have to do what is called an itemized deduction. So you start with your gross income, and then after that you take either the standard deduction or you subtract deductions using the itemized deduction. Now, after you've done that, you end up with what is called your taxable income. The taxable income, then you have to run through the brackets. And then after that, you end up with your tax bill. All right. Now, you through your year, you end up prepaying taxes. So in other words, every time you pay payroll, they take away a little bit of your income taxes, a little bit of your income taxes. Now imagine that your tax bill is something like 21,000, but on the year you prepaid something like 23,000. Then basically, Uncle Sam owes you 2,000, and that's when you get a tax refund. Now, if instead you imagine that your tax bill, so imagine instead that your tax bill is 26,000 and you only prepay 23,000, then basically in that case you owe Uncle Sam 3,000 more, and you got to send them a check for that. All right, so that's the basic way in which we pay income taxes. Most people normally get a tax refund, and the reason you get a tax refund is because you overpaid in your taxes. So in other words, your tax bill is less than your prepaid amount, and therefore Uncle Sam sends you money back. All right. This is a graph that I like to show most of my classes to kind of dispel one of those misconceptions. Most people pay very little taxes. The majority of taxes in the US are paid by the top of the bracket. So if you look at the total amount of income taxes collected by the federal government, 25% of those income taxes are collected from the top 1% income bracket in the US. The highest 20% of the income bracket, which includes that 1%, pays 73% of all the income taxes collected in the US. The fourth 20% pay 17% of the taxes. So between the top 20 and the top 40, the top 40, if you include all of these, pays 90% of all the income taxes in the US. So the majority of income taxes is paid by the top 40% of the income bracket in the US because taxes are progressive. All right? In other words, the higher the income level, the higher the marginal tax rate. This is a quick breakdown of that. So 73% of all federal taxes are usually paid by the top 20% of the income bracket, and the top 40% of the income bracket in the US pays 90% of all federal taxes. So the rich and the almost rich pay 90% of all income taxes. Now, a question you may want to ask yourself is that fair? Well, to truly understand the answer, we need to talk about income distribution. Now, before we get to income distribution, though, we need to talk about the difference between income and wealth. So, income is a flow of money to you. So, income is a flow to you. Then in the middle, you have your wealth. And wealth is a sort of stock, an accumulation of income. And then Flowing away from you, you have your expenses. And again, expenses is a flow away from you. Okay? So there's a difference between income distribution and wealth distribution. But of course, if you don't make enough income, then it's a little difficult to accumulate wealth. So poor people have little income and expenses that are very similar to that income level. Rich people have a high income with high expenses, but usually the amount of income is still much larger than the amount of expenses. So they tend to accumulate wealth faster than poor people, because poor people have a lower income, and even if they keep cutting expenses, it's still not enough to accumulate wealth. So even though income distribution is bad in the US, wealth distribution is actually worse. All right, let me point you to a video on YouTube that you might want to be watching about wealth distribution.
That I can't get out of my head. A Harvard business professor and economist asked more than 5,000 Americans how they thought wealth was distributed in the United States. This is what they said they thought it was. Dividing the country into 5 rough groups of the top, bottom, and middle 3 20% groups, they asked people how they thought the wealth in this country was divided. Then he asked them what they thought was the ideal distribution. And 92%, that's at least 9 out of 10 of them, said it should be more like this. In other words, more equitable than they think it is. Now that fact is telling, admittedly, the notion that most Americans know that the system is already skewed unfairly. But what's most interesting to me is the reality compared to our perception. The ideal is as far removed from our perception of reality as the actual distribution is from what we think exists in this country. So ignore the ideal for a moment. Here's what we think it is again. And here is the actual distribution, shockingly skewed. Not only do the bottom 20% and the next 20%, the bottom 40% of Americans barely have any of the wealth. I mean, it's hard to even see them on the chart. But the top 1% has more of the country's wealth than 9 out of 10 Americans believe the entire top 20% should have. Mind-blowing. But let's look at it another way, because I find this chart kind of difficult to wrap my head around. Instead, let's reduce the 311 million Americans to just a representative 100 people. Make it simple. Here they are: teachers, coaches, firefighters, construction workers, engineers, doctors, lawyers, some investment bankers, a CEO, maybe a celebrity or two. Now let's line them up according to their wealth. Poorest people on the left, wealthiest on the right, just a steady row of folks based on their net worth. We'll color code them like we did before based on which 20% quintile they fall into. Now let's reduce the total wealth of the United States, which was roughly $54 trillion in 2009, to this symbolic pile of cash. And let's distribute it among our 100 Americans. Well, here's socialism, all the wealth of the country distributed equally. We all know that won't work. We need to encourage people to work and work hard to achieve that good old American dream and keep our country moving forward. So, here's that ideal we asked everyone about. Something like this curve. This isn't too bad. We've got some incentive, as the wealthiest folks are now about 10 to 20 times better off than the poorest Americans. But hey, even the poor folks aren't actually poor, since the poverty line has stayed almost entirely off the chart. We have a super healthy middle class with a smooth transition into wealth. And yes, Republicans and Democrats alike chose this curve. 9 out of 10 people, 92%, said this was a nice, ideal distribution of America's wealth. But let's move on. This is what people think America's wealth distribution actually looks like. Not as equitable, clearly, but for me, even this still looks pretty great. Yes, the poorest 20 to 30% are starting to suffer quite a lot compared to the ideal, and the middle class is certainly struggling more than they were, while the rich and wealthy are making roughly 100 times that of the poorest Americans and about 10 times that of the still healthy middle class. Sadly, this isn't even close to the reality. Here is the actual distribution of wealth in America. The poorest Americans don't even register. They're down to pocket change, and the middle class is barely distinguishable from the poor. In fact, even the rich between the top 10 and 20 percentile are worse off. Only the top 10% are better off. And how much better off? So much better off that the top 2 to 5% are actually off the chart at this scale. And the top 1%, this guy, well, his stack of money stretches 10 times higher than we can show. Here's his stack of cash, restacked, all by itself. This is the top 1% we've been hearing so much about. So much green in his pockets that I have to give him a whole new column of his own, because he won't fit on my chart. 1% of America has 40% of all the nation's wealth. The bottom 80%, 8 out of every 10 people, or 80 out of these 100, only has 7% between them. And this has only gotten worse in the last 20 to 30 years. While the richest 1% take home almost a quarter of the national income today, in 1976, they took home only 9%, meaning their share of income has nearly tripled in the last 30 years. The top 1% own half the country's stocks, bonds, and mutual funds. The bottom 50% of Americans own only 0.5% of these investments, which means they aren't investing. They're just scraping by. I'm sure many of these wealthy people have worked very hard for their money. But do you really believe that the CEO is working 380 times harder than his average employee? Not his lowest paid employee, not the janitor, but the average earner in his company. The average worker needs to work more than a month to earn what the CEO makes in 1 hour. We certainly don't have to go all the way to socialism to find something that is fair for hardworking Americans. We don't even have to achieve what most of us consider might be ideal. All we need to do is wake up and realize that the reality in this country is not at all what we think it is.
All right. By the way, besides the ominous music and sort of end of the world thing with that video, I need you to understand that this has been around for a really long time. So it's not really pointing out something that's happening now or during the last administration or anything like that. It's just pointing out something that has been happening. Whether or not you think that's normal or okay or not, then that's a different story. But let me show you real quickly the income distribution all over the world. And this one might kind of shock you a little bit, but this is a quick video on the income distribution in the world. So you understand that even though our distribution of wealth is bad in the US, income distribution in the world may make you feel very lucky.
In the world today, people live on very different income levels. The poorest people live on less than $1 a day. There are people living on 10 times more than that, $10 a day. And there are people living on 10 times more than that, $100 a day. This is the total world population. Each block, 10 million people, like the population size of London or Cairo. Now I will place people on their income level. Below $1 a day, there are lots of people, around 1 billion. Below $10 a day, more than half of the world population. And some people live on more than $100 a day. These are the richest 10 million in the world. There's a huge difference in income between the richest and the poorest. But talking about this difference as being a gap makes it sound as if there were only rich and poor in the world and nobody in between. But there are people on all income levels, and the majority live somewhere in between. So in that sense, there is no gap. But there is a huge difference in income between the poorest and the richest.
All right, so as you can see, there is a huge difference between the rich and the poor in the US. Now, one of the ways in which we show that difference is using something called the Lorenz curve. This right here is the way we build what we call the Lorenz curve. Now, the Lorenz curve is something that we build by using the population amount in equal 20%, and then the income that that population receives, and we accumulate that. So the Lorenz curve is a curve that shows the distribution of income by arranging income from lowest to highest on the horizontal and indicating the cumulative fraction of income earned by each fraction of the households on the vertical axis. Now here's what a Lorenz curve looks like. The line in the center represents equal income equality. On the horizontal side, we have the percentage of households, and then on the vertical side, we have the cumulative level of income. This point that you see here at the 20 represents the point where these three meets that 20. So 3.4% of income receivers receive 20% of the income. Okay, so that's why we go to the 20 and we plot it at around 3.4%. Now the 40% of the income receivers receive the accumulated amount of the top of the bottom 20 and the next 20. So 40% of income receivers receive 8.6 plus 3.4. So when you put those two together, it ends up being around 12%. And that's what you see here on the Lorenz curve. At 40% of income of households, it's about 12% of income. Okay? Then to get to the 60, we add the cumulative income between the bottom 20, the next 20, and the next 20 after that. And then we end up with around 27% or so. You can see here you add this 3.4, that 8.6, and that 14.6%. Okay? And then we end up with about 27% or so. And then that's what this number is. And then the next 20%, so 80% of households. For 80% of households, we gotta add this number plus that number plus that number plus that number. And then we end up with this point here on the graph where 80% of households receives around 50% of the income. So this is what we call a Lorenz curve. Now a Lorenz curve that is closer to the center line is a Lorenz curve that represents a country with less income inequality than a country that has a line farther from the center. So if you compare this light green to this dark green, which is basically the Lorenz curve in the 80s and in the 1980s in the US, versus the Lorenz curve in 2005 in the US, you will notice that income inequality is getting worse. In other words, the distance of the Lorenz curve from the center is greater in 2005 than it is in 1980. Now with that Lorenz curve, we can also create something called a Gini coefficient. The Gini coefficient is a number that we create with the areas that we have. All right, now imagine that these are different Lorenz curves. So let's call this is the center line. Sorry, it doesn't look that pretty. This is a Lorenz curve 1, and then this is Lorenz curve 2. The Lorenz curve farther from the center is the one with the highest income inequality. So if the center line is this one here, then the line farthest from the center is the one with the highest income inequality. So line 2 has more income inequality than the country on line 1. If we were to calculate the Gini coefficient for, say, line 1, then the way you will calculate the Gini coefficient is you take the area of A, which is this area here, and then you divide it by the area of the entire triangle, which is A plus B plus C. if you were to calculate the Gini coefficient for B, you have to add the area of A and the area of B to get to the area of this line here compared to the center line. And to get the second Gini coefficient, you do the area of A plus the area of B divided by the area of A plus B plus C. So to get the Gini coefficient for the second country, aka line 2, you have to add A plus B and divided by A plus B plus C. Now notice that Gini 2 is going to be greater than Gini 1 because this one is just A divided by that and this one's A plus B divided by that. So this Gini 2 is going to be greater than Gini 1. That means that the higher the Gini coefficient, the higher the income inequality in your country. So if you select the higher Gini coefficient, then a country with a higher Gini coefficient also has a higher income inequality. Now, one of the things that I always like to mention somewhere around here is that, yes, income inequality is bad in the US, and so is wealth inequality. But that has been around for a really long time, and this is not new. Maybe it's getting worse, but it is definitely not new. And it's not new now, and it won't be new, and it's difficult to solve. Let me try to explain why. So basically, sorry for that wave over here. So basically, if you look at the way society is built, society outcomes today are built like in a sort of ladder. And it's kind of like, I like to explain that the market system for most of us is really this ladder that we're always trying to climb. To understand what I mean by a ladder, think about the different degrees. So if you have a high school diploma, then the expectation is that you're going to make some money. But then when you get your associate degree, then there's an expectation that you're going to make more money. If you get then your bachelor's degree, then there's an expectation you're going to make a little bit more money. And then if you get your master's degree, then there's an expectation that you're going to make even more money. So basically, a higher degree leads to a higher level of income and therefore inequality. Now, if you don't like degrees, then think about the difference between the best surgeon in the world and the surgeon that got a C in class. Now, the surgeon that got a C in school can still be a surgeon as long as they can get certified for that. But they're not supposed to be making as much money as the best surgeon out there. Or another way of thinking about this is the okay NBA player gets paid less, and then the best NBA player gets paid more. And most people basically equate pay with bestness. So in other words, the person with the most toys and the most money and the most income is the quote-unquote best. I truly disagree with that, by the way, because, the best of a lot of things doesn't mean that it has the most money, but it is kind of like the way society is built. Now, what exactly is taxation? Progressive income taxes, what they basically do is they redistribute some of that income inequality and they move it down to society. Because a lot of the money that we tax you on is used not just for the rich, but it's used for all of society. So I want you to think about I-95. It doesn't matter whether you're driving on a poor car or a rich car, we're both using the same infrastructure. And infrastructure, since it's paid with taxes, it is paid also by the highest income bracket, mostly because people on the top income bracket pay more taxes, they pay more sales taxes, they pay more income taxes, they pay more property taxes. Okay? So taxes is a way to redistribute income, basically, from the top of the bracket to the bottom of the bracket. By the way, the world is getting a little better when it comes to the war on poverty. If you look at the amount of people that used to be considered extremely poor in the world in the 1970s, and by the way, the poverty line, I think in the 1970s, the standard was like $1 a day. This is a percentage of people in the world that used to live with that much money. Today, we have increased the standard for poor, and I think it's last time I checked, it's $1.50 a day. And then now, this is a percentage of people that live with that amount of money. Okay, so the amount of people living in poverty as a percentage of the population is declining. Of course, by the way, today we have more people than we did in 30 years ago. So this percentage may actually be more in total amount of people, but as a percentage, the number is declining. All right. Hopefully, this was a chapter I gave you a bit of an idea on the public choice model, taxes, and income distribution. I enjoyed the chapter. Have a good one. This was Professor Choi.